Picture this. It's 3 a.m., you're doom-scrolling financial headlines, and one number jumps out at you. The United States government owes $38 trillion. Japan owes $9 trillion. The entire planet somehow owes $315 trillion, roughly 3 times bigger than everything humanity produces in a year. Your brain tries to wrap itself around numbers that big and just gives up. But there's one question that should keep you awake. If literally everyone is in debt, who exactly is all this money owed to? The answer will completely scramble how you think about money, debt, and who actually runs this circus we call the global economy. If you're ready to go down this rabbit hole, and you'd rather not have your financial future end up as someone else's case study, hit subscribe now so you don't miss the rest of this series on how the system really works. Now, let me paint you the comfortable picture everyone wants you to believe. Politicians tell you national debt is just temporary borrowing, like a giant credit card that will be paid off eventually. Economists dress it up as investment in growth and counter-cyclical policy. Financial news treats trillion-dollar deficits like the weather, numbers on a screen that go up and down. And most people quietly assume that somewhere in some boring building in Washington or London, serious adults have a plan to actually pay this mountain down one day. That myth keeps everyone calm. The story goes like this. The government borrows money, spends it on useful things. The economy grows, and later we pay the debt back out of the extra prosperity. It's the national version of taking out a mortgage. Scary numbers, but rational and temporary. Here's the part they don't say out loud. The system was never designed to be paid back. Not now, not ever. The debt isn't a glitch. It's the core feature. And the people in suits running it have been playing a completely different game from the one they explained to you in the textbook. To see how this trap was built, we need to rewind to 1694 and a Scottish merchant who had failed more times than he'd like to admit. William Patterson had blown up several schemes, but he had one last idea. England was broke, fighting France, and traditional lenders wanted nothing to do with a serial defaulter king. So Patterson walks up to King William III with one of the boldest proposals in financial history. He'll round up wealthy merchants to lend the crown £1.2 million, roughly $300 million in today's money. In return, the government agrees to something completely new. It will never repay the principal. Instead, it will pay 8% interest, effectively forever. Read that again. The government sells an infinite stream of taxpayer money to a small group of creditors in exchange for a one-time cash injection. Patterson wraps this arrangement in a respectable name, the Bank of England, and Parliament, desperate for war funding, signs off. Future taxpayers can deal with the consequences. But Patterson's true innovation wasn't the idea of permanent government debt. It was the next step. He convinced the state to let the Bank of England issue paper notes backed by that same government debt. The IOU from the king becomes the backing for new money. The more the government borrows, the more money can be created. Debt and money fuse into a single system. Within a generation, every serious European power copied the model. France, the Netherlands, and eventually, by the 1790s, the brand new United States under Alexander Hamilton imported the pattern wholesale. Permanent state debt, interest funded by taxes, bonds that trade like money. Patterson died in 1719 without becoming fabulously rich himself, but the machine he built is still humming more than 3 centuries later. The Bank of England still stands. British government debt has never truly been paid off. It's rolled over and expanded. The basic trap was set. Governments would borrow forever, and taxpayers would fund interest forever. But Patterson's system had an early-stage problem. Each big loan had to be negotiated individually, rates were inconsistent, and only a tiny elite could participate. That's where Nathan Rothschild enters the story, and he's the one who turns permanent debt into permanent dependence. By the early 1800s, the Rothschilds had banking houses across Europe, London, Paris, Frankfurt, Vienna, Naples. This web let them move capital and information faster than anyone else. Nathan, running the London operation, saw that instead of lending directly to governments, he could do something smarter. Buy government bonds at a discount, then resell them to investors at a markup. This created a secondary market. Governments got their cash up front. Rothschild pocketed the spread, and investors received tradable interest-bearing assets. But the truly dangerous innovation was information control. The famous story from the Battle of Waterloo in 1815 captures this perfectly. Through a private courier network, Nathan learned of Napoleon's defeat before anyone else in London. He quietly started selling British bonds, which convinced other traders that Britain must have lost. Panic selling drove prices down. Once bonds were dirt cheap, he bought enormous quantities. When the real news, British victory, arrived, prices soared, and Nathan made a fortune. Whether every detail of that story is literally true doesn't matter as much as the pattern. Rothschild demonstrated that whoever controls the flow of information and the bond market effectively controls government finance. By 1820, any European state wanting to borrow at scale had to work through this network. Here's why that matters for the debt trap. Before this era, a king could, in theory, default. It would be ugly, creditors would be angry, but the system would reset. Rothschild's global bond market changed that. A British bond might be held by a Dutch investor pledged as collateral to a German bank, which then financed an Austrian industrialist. Debt ownership turned into a spiderweb. Default stopped being a bilateral dispute and became a systemic threat. Refusing to pay no longer hurt just one lender. It risked bringing down a large chunk of the financial architecture. That's the Rothschild move. Make sovereign debt so interconnected that default becomes unthinkable, not because leaders are ethical, but because the whole machine might implode. Now governments weren't just permanently in debt, they were permanently locked into servicing that debt. To keep paying interest, they needed to borrow more. To borrow more, they needed to keep markets happy. The trap tightened. By 1900, the United States had become an industrial giant, but its financial plumbing was still crude compared to Europe. Banks were fragmented, the money supply was tied to gold, and there was no central institution to coordinate rescues in a crisis. J.P. Morgan was about to fix that, not for you, but for his class. The panic of 1907 was the turning point. Stock prices crashed, banks failed, and credit froze. Morgan famously gathered leading New York bankers in his library, locked the doors, and forced them to pledge funds to stabilize the system. It worked, but Morgan was 70 and knew he wouldn't be around forever. The solution he and his peers envisioned was simple. Create a permanent institutional Morgan, a central bank. Problem: Americans hated central banks. The first and second banks of the United States had both been killed by populist backlash. So they rebranded. In 1910, Morgan Circle met secretly on Jekyll Island, Georgia. For 9 days, they drafted what became the blueprint for the Federal Reserve. They knew that if the public saw Wall Street designs the money system, the bill would be dead on arrival. So they disguised it. They called it the Federal Reserve System, not a central bank. They split it into 12 regional banks to look decentralized. They added a government board to make it seem public-spirited. But they embedded banker control where it mattered. The regional Fed banks were owned by private member banks, and the New York Fed, dominated by the biggest Wall Street institutions, would hold the real power over open market operations and bond purchases. Congress passed the Federal Reserve Act in December 1913. Many lawmakers didn't fully understand what they'd authorized. What they'd actually done was plug Paterson's and Rothschild's logic into an engine that could create money from nothing. From that moment, U.S. government borrowing changed qualitatively. The state no longer depended strictly on finite private savings. It could issue bonds knowing the Fed could buy them with newly created dollars. The mechanism of infinite debt was in place. Treasury issues bonds. The Fed buys them with conjured reserves. The government spends the money, and taxpayers commit to servicing interest indefinitely. By the late 1970s, this architecture had gone global. Developed countries rolled debt seamlessly. Developing countries borrowed heavily for modernization and infrastructure. Then came the breaking point, and Paul Volcker. Volcker became Federal Reserve Chair in 1979. Inflation was raging above 10%, U.S. credibility was crumbling, and foreign holders of dollars were losing patience. Volcker made a brutal decision: crush inflation, whatever the cost. Between 1979 and 1981, he jacked the federal funds rate up to around 20%, the highest in modern U.S. history. Inflation collapsed, but something else snapped. Developing countries had borrowed vast sums in dollars at low floating rates during the 70s. When rates tripled, their interest bills exploded. Mexico owed around $80 billion, Brazil $60 billion, Argentina roughly $40. Suddenly, the annual interest they owed exceeded what they earned from exports. In August 1982, Mexico announced it couldn't pay. On paper, a wave of sovereign defaults should have wiped out major U.S. and European banks that had made these loans. Volcker and the IMF chose a different path. Instead of allowing default and forcing creditors to eat losses, they designed structural adjustment. The IMF would extend new loans so countries could keep servicing old debts. In exchange, governments had to slash spending, privatize state companies, liberalize trade, and devalue their currencies. Here's the key. These bailouts didn't reduce the original debt. They simply stretched it out, locked in interest payments, and used crisis as leverage to force policy changes. Volcker's move globalized the debt trap. Rich country banks got paid, poor country populations ate austerity, and the principle stayed on the books. We've seen the same script ever since. Greece, 2010, Argentina, 2001, Sri Lanka, 2022. Rescue packages that don't actually rescue. They just keep the interest flowing and the leverage intact. Put all four architects together, and the design becomes obvious. Patterson made state debt permanent. Rothschild made it globally interconnected. Morgan and his friends built a central bank machine that can manufacture unlimited credit to buy that debt. Volcker and the IMF institutionalized no escape for debtor nations by turning crises into restructuring opportunities instead of resets. Fast forward to today. We sit on $315 trillion of global debt, government, corporate, household. None of it is meant to be repaid in full. All of it exists to generate interest and serve as collateral in a massively leveraged financial system. Look at the United States as a case study. The government has about $38 trillion in outstanding debt. Roughly half is held by the public. Pension funds, mutual funds, insurance companies, foreign central banks, regular banks, and the Federal Reserve itself. Those holdings pay around $1 trillion per year in interest. Where does that trillion come from? Taxes. Citizens send money to the Treasury. The Treasury sends interest to bondholders. The bondholders are overwhelmingly institutions owned by the already wealthy. It's a permanent conveyor belt moving purchasing power from workers and consumers to asset managers and creditors. The other chunk of U.S. debt is intra-governmental, owed to things like Social Security and Medicare trust funds. The government borrowed from those programs and spent the cash. In return, the trust funds hold special Treasury IOUs. When those programs need money in future, the government will have to raise taxes or issue more debt to redeem the bonds. Either way, the bill comes back to taxpayers. Scale this globally, and it's the same picture everywhere. Japan owes mostly to Japanese institutions. Europe's states owe largely to European banks and funds. China's public debt is held by state banks and domestic investors. Everyone owes, but the money moves in circles through the same financial plumbing, and the net result is interest flowing upwards to those who own the assets. Here's the punchline no one on TV wants to say aloud. If the U.S. somehow paid off its $38 trillion, the entire money supply would implode. Because in this system, dollars are created when someone, especially the government, takes on debt. Pay off the debt, destroy the dollars. A full payoff would trigger brutal deflation, mass bankruptcies, and economic collapse. The same logic holds for the global system. If governments collectively tried to return to zero, most of the world's money would vanish. So the debt can't end. It must grow or, at best, be rolled over forever. That's not an accident. It's the design. And the beneficiaries are the institutions that sit on the asset side of the ledger. Giant asset managers, banks, insurance companies, and wealthy investors whose portfolios are stuffed with government paper that pays them year after year. Patterson didn't coordinate with Rothschild, who didn't coordinate with Morgan, who didn't coordinate with Volcker. But each facing a crisis made choices that tilted power toward creditors and away from everyone else. Permanent interest, interconnected obligations, central banks that can always buy more bonds, restructuring instead of forgiveness, 4 steps, 3 centuries, one inescapable architecture. Where does that leave you? Inside the machine, whether you like it or not. So here's the mental framework you need if you don't want to get crushed by it. First, ignore the speeches and follow the incentives. Politicians and central bankers will always claim they're protecting the economy or the middle class. But look where the interest flows and who actually holds the assets. Second, remember that demographics, energy, and basic arithmetic will eventually override even the cleverest financial engineering. You can't compound debt forever faster than real productivity without something breaking. Third, whenever you hear about a bailout, a rescue package, or a new facility, ask one question. Who is being saved and who is footing the bill? In this system, the winners tend to be concentrated and visible. The losers are dispersed and invisible inside higher taxes, higher prices, and weaker currencies. Finally, understand that in this model, debt is not a temporary emergency tool. It's the operating system. $38 trillion in U.S. debt is not a problem waiting for a solution. It is the mechanism through which power and wealth are allocated. If this changed how you think about government borrowing and made you realize that the debt crisis is actually a well-oiled business model, you're starting to see how the game is really played. Make sure you're subscribed, because they're definitely not teaching this in school, and the next few chapters of this story are only getting weirder. We'll keep unpacking how this machine works so you can at least understand the rules of the system you were born into. And maybe find a way to protect yourself while everyone else still thinks the plan is to pay it all back someday.